Every time we do this, I get really excited. I honestly do, because it's like seeing a movie. I saw a movie a few days ago, and it would be just like me to say, hey, have you seen that movie? Oh my God. Well, I've seen this movie, this relationship.
Yeah.
And I've got to spend a lot of time with you. And over all these years, I get excited for people to know you. As is every podcast, I try to pick a word that sort of, encompasses not only the kind of word you should know and understand, but that ties so well to who I get to interview. And the word I've picked for you, Tyler, is innovation.
Okay.
It's the next thing, the next adaptation of the next. If we can do this, what else can we do? And so, by way of introduction to Mr. Tyler Vinson from Spokane, Washington, who just drove, mountain passes, winter. This is not just a quick little trip down the street. It's a day, if everything goes right.
Yeah.
To get here.
Well, it became a few days for us, the way my crew rolls.
Exactly, right. And then you add kids and wives, and it's like 3 days.
yeah, that's pretty much it.
Here you are, and I truly am so excited on this podcast for people to just be challenged by your way, by your brain, by if we can do this, why can't we do this? It's the next step. That's what innovation is you keep redefining and growing. And so as a place to start under this big umbrella of real estate, I want to start with real estate. We're going to branch into the philosophical here and there for sure, but I want to start with real estate and you making a decision to go from a very lucrative sales job to transitioning into real estate. I want to start there with the sales job.
Yeah.
And then why from this to this? It's a reinvention, an adaptation of what you already know you have, what you're good at. It got you from here to here, and then we're going to take it from there. Start there, Tyler.
Yeah, great. Well, I also just want to say I'm honored to be here. I really appreciate the invitation. A lot of people, not only around the country and around the world, and I have learned so much of my time spent with you that I was certainly honored to be here. So I want to thank you for that.
Man, I really, truly appreciate it. This podcast, when I'm dead and gone, I will, it's already stated in my will as an intention to share my executor to my kids.
Yeah.
That, okay, I've probably done it all wrong, but I know a lot of really amazing people. So if you would just take this greatest hits album and pull one thing or two things out of each of these, I will have contributed.
Yeah, that's amazing.
That's how I feel. So
Amazing.
You're here for a darn good reason, buddy. So start with that first introduction, that transition from into real estate. Start there.
Yeah, no, I had a great sales job. I was young. I was 21 years old when I started in that sales job, and I sold sport boats and cruisers and motor yachts, and I would travel the West Coast doing the various shows and things like that. I'd won Rookie of the Year. It was, like you said, it was a very lucrative sales job. And then a good friend of mine had actually just graduated from UW, and he came over, and I guess my first unintended experience with real estate was him living in my basement of the house that I bought and renting some space there. But one night he took me to a real estate investment. I don't know. I think back then there was like Carlton Sheets, Robert Allen, Russ Whitney, along with some Greg Pinneos of the world. But so we went and we checked that out, and it led to us purchasing a course over the weekend. And I've been through a lot of education in the last, 24 years or so, and that was probably the worst. was that particular weekend?
That weekend at the airport.
Yeah. So we
Airport Hilton. It always seems like it's at the Airport Hilton.
Yeah, this one was the Davenport, but they were falling asleep at the wheel would be an understatement. But the result of that, and I had to call in work, sick. Tell my boss, sorry, Doug, when you see this, but yeah, I had to call in sick and all that. But we made that commitment. The education was terrible, but when we got done, he said, "Let's go, buy some real estate." And I can circle back to my first real estate deals because they happened after that. But I'll fast forward to the transition. I had gotten into buying a few investment properties by that point and just fell in love with the sport of real estate investment. So while I was still working selling the boats and sport cruisers and motor yachts, my heart just wasn't, and my mind had started to run wild with all of the potentials that's involved with real estate and the opportunities that were there. So while I was still working there, I got my real estate license, and pretty much when that was complete, I decided, and I had been buying real estate during that time, some duplexes and a couple of houses. And so I ultimately, in 2005, quit my job there and made the leap full-time into real estate.
One thing I want to underscore, and this is sort of my way, Tyler, that when I hear something that I go, wow, there's something there that's transferable, that's somewhat philosophical. How many times have I heard that this experience, although it in and of itself was kind of crummy, it somehow still started a spark that led to action, that led to an introduction, that led to you falling in love with something.
Yeah.
Somebody writes a mediocre book, but it's one thought that got somebody started.
Yep.
Or a seminar that may not have been that great, but it started motion enough to where you went from there. And I think that this is where being open to things. Hey, let's go check it out. Let's go check it out. There's no guarantee it's going to go great, but what it might start, where that road might lead. And so, okay, now you're into it. Now you see the potential.
Yeah.
Have you ever kind of contrasted those two worlds? Because the world of sales and boats and the world of real estate sales and acquisition, these two worlds, have you ever kind of contrasted why one is perhaps more wealth producing than the other?
Yeah, well, and I think what you're talking about is sometimes you just got to show up, right? When
Yes.
you don't know exactly what's going to happen, you just make the decision to show up, and I think that was a big part of it. And then second to that was, there's positive motivation and inspiration and negative motivation and inspiration, and in that case, the positive was getting there, and I was inspired to do so. But being disappointed at that, and my friend saying, well, let's just go buy some real estate, ended up doing that. So yeah, I think that there's a big difference between trying to get rich and building wealth, or trying to make money or make a living versus building wealth and a legacy.
There you go. Yep.
Those are two different types of incomes, two different types of capital, as you would probably say. And one of those, you can either lose your job, or, you're at the highest tax brackets, and, you're not always making your own rules to the game. With real estate, I realized that I could make my own rules to the game, that I could do things on my terms how I wanted to, and that I could use real estate as a tool to truly build wealth, really beyond what I understood to be possible for myself back then. So absolutely, I think that one of them was longer term legacy thoughts versus, the boats was fun, and I made good money, and it was great, but I wasn't going to set a foundation for my future that way. At least that's how I felt about it.
Right, right. So I heard you say that the first initial properties were, a couple houses, duplex. What were tell me about that initial go, no-go formula, do it or not do it formula. I mean, what criteria did those early acquisitions have to have?
Yeah. Well, I wish I could answer that in a sophisticated manner like I could today. But back then, it was really about getting to the plate and taking a swing, and that was almost hard enough. I was scared. I was 21 years old. And when we got out of that education, we stood there, me and my friend, and he said, well, we didn't really learn much. And he just goes, well, let's go buy some real estate. And I was like, oh. Okay. And so we went out, and it was quite a process, because the first thing we did is, all the gurus taught, buy a real estate in an LLC. So we went to, this is a line I'll never forget. One of the first places we visited was a real estate attorney's office to have our LLC drawn up. And we walked in the door, and he looked at me, and he said, so you want to be a real estate investor, huh? I said, absolutely. And he said, so you want to live poor and die rich, do you? And he said that, and that just hit me wrong, to be honest with you. And so I thought, no, that's not what I want. I guess I'll be doing it different than you. And so, but we got the LLC, and we got a real estate broker who didn't know anything really about investment real estate other than how to pull it up off an MLS.
Right.
Had very minimal training, but we were starting to read books and things like that as well. Went to my CPA and talked to him about the LLC and how we're going to purchase that. And he had very different ideas than the attorney. It's so interesting how attorneys and CPAs look at it very differently. And then, of course, we walked into the mortgage broker and said, hey, we just started this LLC. We're going to go, buy some real estate.
Said, no. Just started?
Yeah, exactly. You're not getting a loan in an LLC. Well, I don't know who's the fool that told you that. Exactly, 100%. Yeah. So that's where my fascination actually started to grow. Is I started to think, why are they teaching this when that's actually not how it works in the real world?
Yeah.
How is this to be? So we went out, and I'll date myself here a little bit. Back at that time, you could get like 0 to 5% loans. This is early 2000s. On like a duplex, and I was buying in the Spokane area, and
down payment wise, 0 to 5%.
0 to 5, yeah, exactly. 0, and they would cash flow.
Did you have to declare one side of it owner occupied, or is this non-owner occupied?
No, this was non-owner occupied, believe it or not.
And they would cash flow.
And they would cash flow. Yeah, if I only knew, right, back then.
Right.
But yeah, that was really how the first one went, and in fact, I think my first duplex, 1801 West Augusta, was after that we went. I think the real estate broker had found it. The mortgage broker said, you're going to have to do this in your name. I later learned that you can quit claim it to the LLC is how you get there. But we bought that with 0 down. And at the negotiating table, our inspector, we'd never really been through an inspection before, said that there's roughly $3,000 worth of electrical work that needed to be done. We had never done this, so scared the heck out of us. So we sat at the closing table, said we weren't going to close unless the seller gave us the $3,000. So we walked out of there with a signed deal, 0 down, $3,000 kicked back from the seller, and we were off to our first duplex.
Right. Your first experience with untold leverage.
Yeah, that's what it was.
Or fear-based leverage.
It was. That in itself was a good lesson.
Right. Yeah. Wow. Yeah, and this is where sometimes people disqualify the whole world of real estate today, especially here we're in the Northwest, and I just hear it every day. I'm sure you do too, in the Spokane area. But, you just can't buy anything that cash flows without, 60% down or 50% down or, and I hear that and I understand why they say that. And of course it isn't true,
right?
But it does take an approach to the situation that's very, very different than the approach that was available back then. Okay, there were opportunities you could 100% finance and that would cash flow. Okay, maybe now that's not true, but maybe it is. But you've got to structure the deal differently.
That's right.
You've got to think differently about how you put this together. And isn't it interesting how reality creates, if you are an innovator, you're innovating.
Yeah.
You start thinking about, okay, I hear you can't do it that way, but how can you do it?
That's right.
Right. And that is, to me, that is the defining quality, as stated in many articles I've read, of the DNA of the entrepreneur, is that they're curious. You'll never meet an innovator who isn't curious.
Right.
They're synonyms.
Right.
They're okay, how will this work? And most people, or a lot of people, hear, it can't be done, and they don't have an innovator gene, a curious gene, so they just go, it can't be done. But the innovator, the entrepreneur, they ask, okay, but if we did it this way, wouldn't that work?
Yes.
And isn't necessity the greatest motivator toward innovation? Like, this isn't working, so now how do we make this thing fly? How do we do this?
Yep.
And that's where doing it on your own terms, creating your own ways.
Yeah, I think you just described my entire real estate investment career, was just basically that.
A continued innovation to the next thing.
Yeah. Because, to your point, I don't buy a property with zero down the same way I used to, but today I'll buy multi-million-dollar properties with zero down of my own money that cash flow.
Sure.
It's just a different capital stack. It's a different way to do it.
Exactly. And even those phrases, this is where, I tell people all the time that there are people that I know, and I'd like to think of myself as one, but there are people I know, young people like you, Tyler, that you could sit down and start taking notes and not look up for 6 months because the doing is about creating, and the creating then allows the doing, and then the doing opens the door to more innovation, and your knowledge, the ceiling, it doesn't exist.
Right.
Sometimes I liken it to aviation, that there's the 172 Cessna that takes a lot of guts and you're afraid, but you got an instructor there. But that's where it starts.
Yeah.
And yet then there's the space shuttle.
Yeah.
And they're both airplanes.
Right.
And the knowledge from here to there is a lifetime.
Yeah.
And so you are on that path that you'll keep learning until the last day.
That's right.
And that's I just love that. I love that.
Yeah, well, you bring up the instructor piece, and that is such a huge part of it. I mean, to cut to the chase, a lot of my portfolio and a lot of my career was based on creative. I'm known for creative deal structure, creative finance, notes, and all of that. And I needed an instructor to teach me what that was and how to best use it. Those are some of the huge pieces I got out of power players and working with coaching and things with you. I am truly grateful for those things. They have made me millions of dollars, really, quite frankly, and changed my life. And those levels, you do need an instructor. The best players in the game have coaches. In fact, if you really want to be one of the best, you have to have a coach, right?
It's true.
I remember we've done a few different things together, and I remember some of those decisions being, who may push back hardest against me and the way I'm thinking about things.
Right.
When you run a company, people get into a habit of just telling you yes, or if you've had certain levels of success, they're just going to go with it. And you need that, that instructor, that coach to tell you where your blind spots are, to make sure you're reading the right dials, on the plane to get to where you're going. So, absolutely, I'll be a student until the day I die, no doubt about it. I've had the honor to be able to teach now, which is another form of learning, but I couldn't recommend that to everybody more, to make sure that you're always leveling yourself up by bringing in an instructor, a coach, a mentor, somebody that can help you get really your full potential. That's what this game is about, is bringing out your full potential. What are you really capable of? Because if you could do it, should you?
Right. Wow. I want to break that apart into sentences to just every word you just said. I so agree with. Tomorrow evening in this very space, just up there in that office, one of my power players is bringing her father by. Her father is now about 80 years old, retired, but he's known as not only one of the Northwest's greatest jet pilots, but he is the one that if you want to get type rated in a Gulfstream or a Citation jet or a Hawker or any of the private jets that billionaires fly around, he not only knows how to teach it, he's got thousands of hours at it. He's known as the #1 instructor in any one of those jets, flown all over the world with names everyone would recognize.
Sure.
And would you like to meet my dad? Would you like to talk? Are you kidding me? We'll block off the entire evening. I'll have the hors d'oeuvres ready, and I'll have a notepad. And can I please record this? Because I've only got 5,000 questions.
Yeah. And
Tyler, especially to young, talented, smart entrepreneurs, the way a mentor helps isn't necessarily let me show you what to do. It's let me protect you from a route that's really going to hurt.
Absolutely.
You don't see this coming, but I do. I've crashed right here. You see that little, that right there on the map. I crashed there. I learned a hard lesson about weather, as it were, metaphorically, right there. We're not going to go that route.
Right.
I'm going to tell you why, and because I care, we're not going to go that route. But let's talk about how to get there seamlessly, more profitably, without wasting your time on the crash, on the report, on the, it's like you get a fender bender in a car. And I don't know about you, but the first thing I think of is, oh my God, once you know everybody's okay, nobody's hurt, but then you go, oh no, this just added a month to somebody's due list to deal with insurance companies, to turn the damn car in, to get the rental car, that wasted time that I just created by backing into that stupid light pole in Safeway that I didn't see, the wasted time of me or somebody that I work with to get through it. Oh my gosh, time is a huge currency. Well, saving time, saving pain, challenging the full vision of the business plan to say, where are we vulnerable here? Where's the engineering? Do we have redundant systems? If this goes out, are we screwed? Where's the Achilles in this plan? Because if one quick swipe can take you out, we need to rethink new engineering. That kind of thinking is what a seasoned veteran does. Much like you teach people now to go, we'll get there, but let's go a different route. Let me save you some pain here.
Yeah, I would argue that that's actually more important than being told what direction to go.
Absolutely.
If you get a little bit off course, you can always course correct.
Yes.
But if you crash, you could be dead.
That's it.
I mean, that's right. Absolutely true.
Yeah. Well, this innovation started with these couple duplexes and you're a kid, but as they say, you're a quick study, and it evolved quickly. And on that path of evolution, one of the things that sometimes people decide is that, well, in order to do bigger things, I have to bring on help. I have to bring on people so that we have more eyes and ears to get there. And so the world of partnerships is everywhere in this business.
Yeah.
And so it was about when we met, or roughly in and around that time,
Yep.
when I met you, you were partners with another individual, and that partnership kind of came, it did its thing, and then fairly quickly was dissolved to go on your own. But there was this little partnership piece. Without naming any names or blame,
Sure.
but what did you learn? Are there some bullet points you can throw out as being helpful about this partnership piece?
Yeah. Oh boy. No doubt about it. And you're right. That actually was, perhaps we had crossed paths, I think, in an investment meeting in Spokane, but that's where our relationship really began, as you had given me a phone call after spending some time, and we had that conversation.
Yes.
Because I was in a partnership, and there is, in my eyes, blame to go around, and the blame is on me. Mm-hmm. And the reason that the blame is on me is because I should have done a better job knowing who I was going to get into a partnership with. I'm the one that chose to get into the partnership. I'm the one that, had a successful baseline. We were a very small company, but we were, doing well. So I made that choice. So, the biggest thing there is you really need to know who you're partnering with and do due diligence on there. And I don't mean due diligence like you're buying a duplex. Mm-hmm. I mean due diligence like you are buying the biggest real estate investment of your life. Mm-hmm. Because the downside of that can be far worse than just a real estate deal.
Loss of money.
Yeah, yeah, absolutely. Loss of money and time and energy and stress, the emotional piece. The money is actually the easier part of that.
Yeah, what I was saying is that far more devastating than just losing money.
Yeah.
It entails every tentacle of life. Right.
Yeah, it does. And I would never be in a hurry to get into a partnership. Now, there's different types. There's shorter joint ventures. But if you're really looking to partner with somebody and build a business with somebody, or whether that's a real estate investment business or even with your private investors, this is just as important. Just because somebody says, I'll loan you some money, or actually I would never put it that way with private investing, I'll invest money with you or alongside you, same. You want to make sure before you take any money from them that that's not going to be, the worst decision you've made in a long time. So I think those are my two biggest mistakes that I learned from the partnership is, one, I didn't take enough time in the process because things probably would have bubbled up. You're around somebody or sniffing around long enough, right? They can only hide so much, if you will. And then really deliberately doing due diligence should have been done on my part, and I didn't. I just saw that they hit a home run. I was in the stands when they did it, and I thought, okay, well, we hit base hits like crazy, and I'll crank one out of the park once in a while. Here's a home run hitter. Let's put him number 4 in the lineup and rock and roll. And they never hit a home run the entire time. In fact, they pretty much struck out, and the team lost. So that was big, and the advantage I had in creating the relationship with you at the time is when you're in it and you've committed to it, you want it to work out so bad. And I'm loyal and I'm not a quitter. So those are not good combinations if you're in a bad partnership, because you believe that you can stick it out. It's not till somebody that has more knowledge in that area than you do that can come and say, look, take a look at it from this angle, right? This is what I see. Why don't you think about that?
Or even somebody that doesn't necessarily even direct it, but you can hear it in the questions. Like, okay, tell me why why you have this partner.
Right.
And then of course you're thinking, wow, are you reading my mind? Because I was just wondering the same thing. You know? In other words, explain this to me. Sell me on this. Go ahead. I'm waiting, kind of thing.
Sure.
And when you can't, then, in other words, I think sometimes just somebody asking the hard questions and making you give good answers.
Yeah.
You know, I've asked people, I can think of 1,000 times in my life, you know, truly, why do you live here?
Mm-hmm.
And because I can tell, we've just spent a day in the worst place on planet Earth. At least I think so. Why do you live here? Why is this where you want to build? Well, it's all I really know.
Mm-hmm.
Okay, all right. But what if you knew someplace else? Would that, maybe now you'd have an option? You know. In other words, just probe you into thinking beyond the conclusion you've already had, like you said.
Yeah.
And then you add loyalty, right? And you add, I'm not going to quit no matter what to it. And you've almost put yourself in a place of now you're really not moving just out of principle.
Right.
Well, but what are you trying to retain?
Yeah.
You know, so yeah, you've said it all. But really due diligence and be slow to make those decisions.
Yep.
Yeah. Yeah. And so from there, it quickly evolved into now you going your own road and building your own companies.
Yeah.
Like, tell me, like, if you were to put in like under 4 umbrellas, the companies that you run, just so we could start talking about each bucket. Mm-hmm. Go ahead. I know them, but I want you to kind of underscore the big rocks of brokerage being one. Okay.
Yeah, and this has actually changed quite a bit even within the last 12 months.
Yes,
shortly after that, brokerage and property management and acquisition were all part of it. And then there's subcategories like the private equity and then the asset management that kind of goes with the property management. So we did third-party property management as well as my own assets. I've always done acquisition ever since my early 20s.
Yes.
And so those were really the buckets that I was in. And more recently, I've narrowed that down. We still do brokerage, but I've got a different designated broker that's stepping in and going to run that. Mm-hmm. Acquisition is still a big part of it with the asset management, but not third-party property management anymore. We're only managing our own assets. Mm-hmm. And then most recently, real estate tokenization. Mm-hmm. That is really where everything we've talked about with creative real estate, private equity, deal structure, and we can talk about, raising capital and all of that, which is a big part of it. But that led me to real estate tokenization, and that is one of our main companies we launched early last year.
Mm-hmm. Okay. And I like that, because you could say the world of like brokerage. Well, that still doesn't tell it all. It could be residential. It can be commercial. It can be a brokerage account where your whole focus is acquisition within the brokerage account. A lot of ways to do this, but those are the big buckets. Let's take the acquisition side.
Yeah.
Transitioning from the single family world, it went fairly quickly into much bigger buildings. And those bigger buildings involved various forms of acquisition strategies. Some where you would simply have an investor to provide some of the capital to do that deal, and they would be paid as an investor. Mm-hmm. Others with an equity share as well as invested capital.
Yep.
And then that sort of morphed and innovated into a fund, starting a fund. Now, I think that the first two, at least I think, are fairly familiar with people, that you can borrow money from people to help buy your real estate. You can give them a piece of the equity and pay a return on the capital, either or. But starting a fund isn't done every day.
Right.
and it's got a lot of nuance.
Yeah.
Give me in a nutshell what you learned about where a fund is based, the SEC, all of the various guidelines of being that money manager in charge of a fund.
Yeah.
Wow, that we could spend 5 hours on this, but
Yeah.
give me a nutshell of that, because that fascinates a lot of people that have never done it. Like, how do you do that?
Yeah, I think the biggest thing there is these are SEC, Securities and Exchange Commission, regulated funds, or you need to find an exemption to registration. I mean, when you raise private capital for others, there's something called the Howey test that folks can look up, a few short steps. But if somebody invests money with you, and it's completely on you to produce a return from them, and they expect a return, you're basically in the world of securities. So now we're talking SEC. And normally if you're, raising smaller amounts, you can fall into joint venture categories, note categories, mortgage categories, and be okay. But when you're raising millions of dollars, you're going to be on that radar. So first and foremost, you need to make sure that you're compliant. And that boils down to how you want to raise the money. Why do you want to raise the money? And how do you want to raise the money? Because there's certain SEC exemptions to register. So two things on the security. You either have to register the security like a public company would, or you need to find an exemption to registration. So in the real estate world, syndications, we're almost always finding an exemption to registration. That's really what we're doing to be
Registering
compliant.
a public offering.
That's
It's
right.
not a public offering necessarily.
No, you're right.
It's
yeah.
tighter to the vest, like a Reg D private offering. for example.
Exactly right. So Regulation D is what's normally used, and that's why I say it depends on how you want to raise the money. So the two of the most common out there are a Reg D 506C and a Reg D 506B, and you will use one of those depending on how you want to raise the money. For example, if you already know a lot of the investors that you want to bring aboard, and you have what they call a pre-existing relationship, and you wanted to bring in some non-accredited investors. So should I go into what accreditation is?
Sure.
Okay. So in this world, there's two, we'll just oversimplify and say two types of investors that can go into these. An accredited investor is somebody that has a net worth of $1 million or more, not including their primary residence, or they make, I believe the numbers are 200 or 250 as an individual, 300 grand as a married couple, for consecutive years with the expectation that you'll continue to make that into the future. That's what's called an accredited investor, and that's not to be overlooked because there's a very certain range of rules between an accredited investor and a non-accredited investor. A non-accredited investor is, of course, not going to meet that specific criteria. So if you wanted to have some of those individuals in your fund or your real estate syndication, then you're probably going to use exemption Reg D 506B, which allows for that. And you can go look that up, but it's a pretty strenuous list of requirements, disclosures, form filings, private placement memorandums, operating agreements, subscription agreements that you need to have into that. And the biggest thing, I think the one warning I'll put to people out there is you cannot advertise for those investors. You can't just put it on Facebook or in the newspaper and say, hey, I'm looking for investors to raise money for this. That's actually illegal. And I think most investors, when they're getting in, don't realize that. But once you get on a little bit bigger stage, a bigger scale, oh boy, they're looking for you for those things. So that's a 506B. You can have up to 35 non-accredited investors. You're going to need all of those disclosure documents that I just listed, the offering memorandum, private placement memorandum, operating agreement, subscription agreement, all of those things. and you can raise money from people you have pre-existing relationships with, and that's got its own definition, right?
Right.
Oversimplified, it's
Right.
like,
Not
3
necessarily
interactions.
friends on Facebook.
That's right. Yeah, that's not going to cut it, right?
Right.
No, or you bump into somebody at a grocery store or even at a real estate investment meetup.
Yeah.
If you meet up with somebody at one of those networking events and invite them straight into your 506B, you're not going to meet the safe harbor.
Right.
Is what these regulations are for. You're not going to meet that federal safe harbor criteria. So that's one of them. A Reg D 506C says that you're only going to have accredited investors in your fund or your syndication. And that's a little bit different world. There's actually a little bit less disclosure involved in that. And you can advertise to the world.
Because theoretically, you're dealing with very experts, people who are very well off, educated, financially set. So there's actually less liability with those people.
Yeah, a lot less liability. The SEC looks at it as if they have $1 million net worth, not including their home, or they're making the type of income, married couple, 300 or more per year, that just based on those facts, they're sophisticated enough to invest in your project. Now, you still need to file a Form D, right, to qualify for these exemptions, because that's what we're doing, is being exempt from registration. You still are going to need to file a Form D, have an offering memorandum or private placement memorandum, an operating agreement, a subscription agreement, which is, what they sign that says how much they're going to commit. And then there's something called investor accreditation. They have to go through a specific verification of accreditation. And not to get too much into the weeds here, but you can do it yourself as the issuer of the security, which is a sponsor, a syndicator. Or there's third-party firms that you can pay a fee, $30-$40, and they'll do it, for you as well. It's really not something you want to mess with, though, because if you do a Reg D 506C, and somebody says, "Oh yeah, I'm accredited. Here's my questionnaire," because you can't even show them the offering memorandum until you've at least got a questionnaire where they said they're accredited. And then when they sign the subscription agreement and send the money, you've needed to take reasonable steps to verify that, and that's usually a letter from their CPA, a letter from their attorney,
Right.
a letter from their financial advisor.
Right.
But if a non-accredited investor gets in your 506C, you lose your entire exemption. Right. And you may be subject to paying every single penny that somebody invested with you back, potentially with penalty and interest. Could be a really, really ugly situation. So it's definitely not to be taken lightly.
You can, two things have just jumped off the page, Tyler, and I have to just say it as I see it. One, I can just almost put myself into the minds and the space that people are listening to this podcast in. And first of all, they realize they can't write fast enough, so they're already knowing that they're going to have to rewind this to hit this. Second thing is that there's no substitute, none, no shortcut. There's no bullshitting your way through something like this. You don't go, "Oh yeah, I want to fly and get in this and take off." No, you're going to have hundreds and hundreds and hundreds of hours and training, and it just comes out of you. This is bloodstream.
Yeah,
it's bloodstream. You know it. You've lived it. You could be asked. I could ask you any question around these, and you know it. Yeah. So. To me, this is also one of those things that high achievement is never casual. It just is not casual. It's deliberate.
Right.
You have to know your stuff. And so setting up a fund like this and where the home base of this fund is and all of the various layers of protection you might build in, and a team of experts, CPAs, attorneys who specialize in Reg D 501, you know what I mean, who just know it intimately and can guide you every step about compliance. Wow, how critical is that to get in that pool? Is it worth it? Yeah. Is setting up a fund to have available capital for the opportunities that you see as the fund manager to put these funds in play and money at the ready?
Yeah.
Is it worth it?
Yeah, I think so. I think there's two types of funds. One is the type of fund where you already have the assets, you're just grouping them together and recapitalizing. But the other is a blind fund where you're just raising money and you don't have assets in there that you've purchased yet. Mm-hmm. And so, yeah, you need to be very, very on point and specific on what you intend to do when you're doing that. It's a much harder sell to sell the blind fund. Mm-hmm. I remember I did a $10 million blind fund, was the very first one that I did. And I really needed to know who was going to go into that fund and why. But it really gives you a huge advantage when you are negotiating the deal. Number one, you know what your cost of money or cost of equity is going in. Right. So it allows you to negotiate much quicker and on the fly. Mm-hmm. It also allows you to come in and pay cash for deals. Now, I'm not a big advocate for paying all cash for deals unless I'm going to recapitalize it pretty quickly. Mm-hmm. So with a fund, you can pay cash for deals and beat out the next guy and then, refinance it or recapitalize it.
And refinance.
Yeah. And so there you just, when you put it together in the first place, you need to be really clear on the type of assets that you're going to purchase, not only for disclosure reasons, because you want to keep within those lines, but for projections of returns, because you may, in a blind fund, buy a performing asset that already has strong cash flow, right? Mm-hmm. Or you may also buy in that fund a complete repositioning where you're going to yank out most of the tenant base. It's not going to cash flow for a period of time, and you're going to put them in there. And what does that look like for the fund on both a cash-on-cash perspective or an internal rate of return perspective when you ultimately exit those? And so it's got to be well thought out. It's not like, oh, let's put a bunch of money together and let's just see what kind of real estate comes up and we'll buy some. First of all, you're going to have a really difficult time raising funds based on that because it is a tougher raise. And second of all, what if you say in your offering memorandum, your PPM, that we're going to buy, apartments and multifamily and that's what we're doing. And then you decide down the road to buy a couple of industrial buildings that were vacant. You thought you were going to convert them or do something cool. The deal doesn't go right. You got a problem.
You got a problem.
Because that's not what you said you were going to do.
Right.
And so those are things that are the potential, downsides of a fund. So when I did mine, I really covered the gamut. So I laid out different areas of the country that I was going to be investing in, different asset types. I even had put in into my presentation assets that we had made offers on or were making offers on, or I think at the time I had one under contract and hadn't closed on it quite yet.
Examples of what
Examples,
you
yep, that's right. So then the investor could visualize where their money was going to go to work at.
Sure.
They really had a good idea of, okay, this is the type of thing this fund is going to do.
Right.
And in the negotiation, it just gives you a ton of confidence because, you don't have to turn around right after that meeting and start hustling the bus to raise a bunch of funds.
Right.
You're all ready to go. And that confidence, at least in my experience, has worked its way into those negotiations. They feel the confidence coming off of me that I know that I can deliver on what I said I was because I've already got my investors on board, committed, and ready to roll.
So there's almost two interesting parts of this that I see. One is that the seller of this property, you have leverage with the seller because the money's here. Mm-hmm. It's already committed. Its soldiers are ready to be deployed.
Yep.
They're right here. And that makes it great from a buying perspective. But from a fundraising perspective, you said that raising money in the blind fund is a more challenging proposition than any specific acquisition involving either the borrowing of money or some kind of joint venture, equity share, something like that.
Yep.
So, it's difficult to set up and get going, but once done, it is an advantage on the buying side. I remember, in younger days for sure, talking to people about the opportunity to employ their dollars in a profitable way in real estate. And so many times I would get the reply like, all this sounds just great. Call me when you've got a property to look at.
Yeah.
I want to see the asset. I want to understand the specific location, expandability. I want to know the numbers. I want to see what the vision is. And it's not that I don't trust you. I'll deploy money when I see the exact place it's going to buy.
Yep.
And so to get to a place of having multiple examples, to have a track record of performance, I guess I'm sure have experienced that it becomes easier to raise blind fund capital the more experience and the track record you have.
Oh, no doubt about it. In fact, if you haven't had much experience raising capital, I wouldn't recommend it, because the double-edged sword there is when people give you their money, guess what they're expecting? A return. And you better perform. You better get that, money working immediately.
Right.
And you can set it up different to where, some people set it up where they are starting to literally pay a return from day one. I haven't done that. To me, that's too much risk, and I haven't had to. But even when they commit their funds and I have them wire it to a trust account, and then once I am ready to deploy it, it goes into an operating account. But while it's sitting in the trust account there, oh boy, you're under pressure to make sure that you are on it and getting that. And that pressure can be really good.
Yeah.
You can be good in putting it in there. But if you don't, you could have just wasted somebody's time and effort. Hopefully you didn't touch the money and you can send it back, right? But if they put their money with you for 3 or 4 months and you ended up sending it back, you're probably not getting, I guess better than losing it, but they don't have a lot of faith in you next time to get those funds deployed. So you do want to be careful of doing that. One thing that I think I've attributed to my success, especially in the early days in raising capital prior to doing like a blind fund, was that I was always getting investors ready for the next deal, and I was always presenting a deal to them that they couldn't invest in. My number one thing would be I would build my list of private investors, and I would get a deal under contract, and I would normally know which investor or two was probably taking that. But I would sell it to every investor down the line. And I would say, hey, I've got an investor here. I've been working with them for a long time. I promised them first look. If for some reason the timing doesn't work for them, you don't want to say if the deal doesn't work for them. You don't want them to think you're, not putting together fantastic deals that you should say yes to every time.
Right.
But if the timing doesn't work for them, then I'll give you a call and let you know. So they have it, because the very first time they ever look at a deal of yours, they have a propensity to say no, right? But if they have a fear of missing out, it's a totally different thing. So my investor would always take the deal, and I would always call down the list and say, the investor took the deal, no surprise there. But, we've been talking recently, is this a deal that you'd be interested in being at the top of the list at? And the next one I get under contract, I can give you a call and you can be in definitely put me there. And from there, they've already had the opportunity taken from them. You've got the social proof that somebody else took it. Right. And I really never can remember a time that somebody ever said no to that, because if somebody says no, well, unfortunately, I got to move you to the bottom of that list, because I need people that are ready to say yes.
Exactly. And I've seen people that when you say, oh, this has already been taken out by this investor, they say, yes, put me at the top of the list for the next one. But they also very clandestine to check out the current one and watch it.
Yeah.
They see it go well, and then it's like really crazy. Oh, should have got in on that one. So then they start calling you like, have you found it yet? Have you found it yet? I'm batter up. I'm batter ready.
Absolutely.
And so, yeah, performance drives that for sure. But on the flip side, something you said way back here about the different forms of offering is that creating a blind fund and having money at the ready, all based on a memorandum that says this is exactly the game plan. This is exactly how the money's going to be used. This is exactly the product type, the location. You're very specific about that. To when you have a fund set up that says this is what we're doing, simultaneous to this fund being set up, you've got to be about the doing of finding and getting under contract and moving these along, because I've seen it. I've witnessed it where all of a sudden here's many, many, many millions of dollars in this fund with a commitment to pay these returns, but the product type and the model just wasn't there. So I've seen people venture outside that model and start placing these funds in things that were outside the scope of the memorandum objective.
Yep.
And then those things don't work out as well as the model, and then all hell breaks loose.
Yeah, I mean, they
you
could
got
call
to
it
be very
fraud.
careful. Yeah, very careful. So, I don't know. I just think that when you wade in to a federally regulated fund, you have to recognize the compliance piece is absolutely huge, and therefore attorneys to prepare the documents, CPAs to prepare and approve the documents, the language of the offering, the details really matter to set it up correctly and then follow the guidelines. That's probably the best 20 minutes on setting up a fund that I think I've ever heard. Just fantastic information, Tyler. So product types and the evolution of this journey of yours. You're one of these guys that has really built. If we think of the person that starts with a house and then the next thing you know it's apartments and on and on and up, intellectually and product type, your curve has just been this vertical growth curve. Talk to me about how that knowledge base, how is that knowledge base innovated into this whole new world of tokenization of real estate?
Yeah,
because it seems like we're taking a big leap, but are we? You know, I think that's the pause I want people to understand, is that this is almost a logical step for somebody who really understands this stuff.
Yeah. And
walk me through. I don't think people even recognize what that means. You know, if owning real estate is our objective for all the obvious reasons, the equity growth, the cash flow, the tax advantages, et cetera, the wealth creation, the leverageability of this. Okay, that really hasn't changed in the objective, going all the way back to that first house you bought or duplex.
Right.
But the platforms and the way you go about it and the way you see that same opportunity of creating those things for yourself and your family, those things have absolutely changed.
Yeah.
So walk me through that.
Yeah, so when we say real estate tokenization, what we're talking about is real estate on the blockchain. That's what we're doing, and tokenization allows you to fractionalize the ownership. So, but the biggest, I think, misnomer is people get into, real estate on the blockchain, and they start grouping it in with crypto, and they get all excited about the technology, but the technology is nothing without the real estate. Underneath the technology is still fundamental real estate. But based on my background of putting creative deal structures together and the finance of it, is what led me to really fall in love with tokenization. So I kind of would like to tell 3 short stories, a past, a present, and a future.
Perfect.
Of what really led to this. So a couple years back, I was coaching my daughter's soccer game, and I'd come off the field and was getting waved down. It was a dear friend of mine from high school. So we were super close, and I see her, and big hugs, and how you doing, and all of that. And she's just excited, and she goes, "Tyler, it's just been so cool to watch what you've done in the world of investment real estate. And my husband and I, we've been working really hard and saving up, and we would love to invest with you." And we just looked at each other in silence, and she said, "But we don't have enough money, do we?" And that goes back to those 506C deals. She was seeing that I was doing accredited investor deals. That's how she saw them out there, that I was marketing, and that just broke my heart. It just didn't seem right. It's always been my vision from the early days to bring people. My life mission is to help people build wealth through real estate and achieve freedom through cash flow. So I realized that it was very difficult for her. She wasn't the type to be able to make it to a Power Players. She wasn't going to, be at some of these educational events. So she really had no way to do it. And that's where the burning started boiling up and percolating. So if I bring it to the present, in the present, I know this has been a challenge for me and my properties and is rampant in the world. Real estate has one major problem, and it's liquidity. Accessing the liquidity in real estate. Mm-hmm. So many real estate investors, definitely raising both of my hands, with millions of dollars in equity, but when they need the liquidity, what are you going to do?
Right.
Especially in a high interest rate environment. Mm-hmm. Where maybe the banks aren't really loaning, or it takes a lot of time, or it's expensive, or the appraiser brings it in at a really crummy price and the bank's writing all the rules. I mean, we're having liquidity issues today. Mm-hmm. And so the beauty of tokenized real estate allows these asset owners, these apartment owners, or whatever type of asset, to access liquidity much quicker and much easier. And that just solves a lot of problems. So I'll circle back to how that works. I'm going to kind of jump into the future story here. So here's what the future looks like. Right now, you get let's just say a college graduate becomes a single mom. I'll just throw some stereotypes in there. But a hard worker, and she goes out and she rents an apartment, and she starts working and saving up some money and wants a future for herself. But what are her investment options when she's saved up $3,000 or $5,000? Not much. The stock market, or more recently crypto, right? Mm-hmm. Some very speculative and not even real in most cases investments. Mm-hmm. And then what happens after 12 months? A rent raise, right? Where she becomes more poor and the asset owner becomes more rich. And we live in an inflationary world, right? And inflation in the long run is going to be part of the world that we live in. And don't get me wrong, I've benefited greatly off of it the last handful of years. But it's creating a socioeconomic gap that's not sustainable out there. And so here's what the future is. In the future, this gal will save up her $3,000 or $5,000, whatever it is, and she'll look for investment opportunities. Mm-hmm. And she'll get onto a website like ours, like REtokens.com, and she'll go there and she'll see her apartment building. She could actually buy a piece of that. Real ownership with real cash flow, real K1, which would be tax benefit, real capital appreciation involved, right? Mm-hmm. And she can actually buy some of that with her money. And
a piece of the depreciation?
That's right. Mm-hmm. Exactly sure. Right. Exactly
so
right.
A write-off as well.
Mm-hmm. Yeah. Mm-hmm. And so, one thing, I'm not a big crypto guy. There's a couple staples, that I'll buy, but overall, most of it is something you want to be very careful of. Is probably an understatement. Mm-hmm. I'm not big there, but one thing I do like is that it taught a lot of young people about the money system. Mm-hmm. It taught them about the how to invest a little bit and how to lose in those investments as well. So when this gal goes and she buys a few pieces of her real estate, right, $3,000 worth, let's say, do you think that opens up more interest for her to maybe learn about investment real estate and learn about the process?
Sure.
And then what happens at 12 months when the rent raise comes? Where before she was shaking her fist at the man, right? But now she actually caught a little piece of that. What happened to the value of her real estate tokens that she just bought? What happens if we run into a majorly inflationary environment to where before people without assets were getting pushed to the bottom of the pile? Now she can actually ride that wave and learn about it more, perhaps get more interested, continue to invest in it. And the value of that went up. So she would actually ride that inflationary wave. And that is the future. So, for example, the platform that we built and are continuing to build out of real estate tokenization allows asset owners to raise capital in a completely different way without a bank loan. They can raise it same day. There's still all the current regulations. We talked about some of those. But you can raise equity in very small pieces. See, when I've done my projects in the past, it's the lowest minimum buy-in I've ever done when my dear friend can't invest in it is this 50 grand minimum. That's the lowest you can invest with me, right? Well, that really is a small group. When you think about it. I mean, you get into the institutional world, it's nothing. But for the average person, that's a lot. But now somebody can invest for $1,000, $3,000, $5,000. So it makes it much easier to raise that liquidity. And so that's a huge benefit for asset owners and the investors to be able to buy into them. So we're also integrating the first secondary marketplace in the world. That's not vertically integrated. And they have to follow the same regulations. So, all right, we're going to get a little bit deep in the rabbit hole here.
In the weeds.
In the weeds, that's right. But what we've been talking about with these regulations are what's called private securities. These are securities. That's why they have to have these regulation exemptions that we spoke about earlier.
Like an equity sharing situation.
Yeah, exactly. A real piece of ownership. LLC membership units would be an example, right?
Yep.
And
which is a security.
Thank you. Yeah, exactly. Which is a security. So there's a section of SEC law called Rule 144, and it allows for the secondary sale of private securities, which is exactly what these are. Now, in the past, this is where the technology comes in. It's been extremely cumbersome to try to buy, sell, or trade your shares of private securities, especially if you're talking about 5 grand, 10 grand, 50 grand, 30 grand, 1 grand. Like, you don't do that. You get an attorney, I'll get an attorney, let's negotiate, let's meet, sign the paperwork, maybe I need an appraisal, all these things in the middle. But with the capital platform, which is like our platform, as well as the verification that the blockchain provides, blockchain is just a digital ledger. You could kind of think of it as an immutable Excel spreadsheet where all the data's in there and everybody can see it, and there's a consensus that everybody agrees it's accurate.
Like a receipt.
Exactly, and nobody can change it.
Right.
Well, now for those smaller because you used to have to invest all that process. Now you can click a couple buttons to raise that money or to sell those. So under Rule 144, when you create a security, there's a 12-month lockup period before you can resell it. But after the 12-month lockup period, you can sell those to non-accredited investors or retail investors. So now you have a huge pent-up demand. Just go to any real estate investment meetup, right? And they all want to invest in real estate. They typically have one problem. The entry barrier is too high.
Right.
Well, now, in the very, very near future, they'll be able to get on and invest in my Class A storage complex for as little as $1,000 and get all those benefits we just talked about, the K1, the depreciation benefits, the cash flow benefits, the upside. So that's what it looks like in the future, is fantastic access to not only investors in the U.S. under Reg 506, Reg D is what we were talking about, but there's a huge interest globally in United States real estate. And that's an exemption called a Reg S. So if we lace a Reg S into our investment, now anyone around the globe, and they don't have to be accredited in a Reg S outside the U.S., now anyone in the globe can invest in your real estate. And when you have that much demand in your limited supply, what does it do to the price of your real estate? It goes up. Because you and I, as professional real estate investors, I'm going to oversimplify. Let's just say we don't consider anything under a 7.5 cap performing. We just don't do that. Why? Because it's illiquid. You know, it can be hard to sell. It's complex. There's a lot of middlemen. There's tons of expense to sell real estate. So we need that type of return. But people will invest in like a REIT, a real estate investment trust, for only like a 3% return.
Right.
Why? Because they're liquid, right?
Right.
And so if you can Google an illiquidity discount. And that's what that means is that real estate sells for a discount relative to the return or the cap rate due to its illiquidity.
Sure. Which typically every private offering, every Reg D private offering, every equity share, oftentimes is seen as much more illiquid than any publicly traded stock or offering, right? Because the platform which shows this opportunity to the world just doesn't exist in the private equity world.
Yeah.
And so oftentimes even the manager of that equity fund, right, will put in a first right of refusal clause, put in a buyback clause, how does that property owner position himself or herself with this equity to enter their property into a tokenization platform with those sorts of restrictions that are often a part of that LLC's membership agreement?
Yeah, what a great question. So when I did this on my storage complex, because I tokenized that, and I did exactly have a first right in there, these documents were created prior to this world of tokenization.
Right.
And so what I did is I honored the current operating agreement. We valued it, gave people a chance to buy and sell at that moment, and then we actually had to execute a new operating agreement that removed the first right of refusal because we want to go onto the secondary market.
Right.
So back to the case of you and I only doing a 7.5 cap, every school teacher, firefighter, police officer, bartender will line up for 4 city blocks to buy it at a 4 cap. Right? And to oversimplify, let's say a capitalization rate is a cash-on-cash return if you don't have debt on the property. The reason that you'll line up for 4 city blocks to buy at a 4 cap is because you don't have access to that type of real estate. For $5 grand, 10 grand, 20 grand.
You're not buying a 300-unit apartment building.
That's right. That's right. Real ownership, real cash flow. You don't have access to this. So something that really produces a 4% return that has the tax benefits of real estate, that has the upside. So when the sponsor, the person running that investment, because this is still real estate, there's still somebody making it more valuable and operating it and doing all the real estate things. But you get to participate in that in the long run, and that's something those guys have never had access to. So it really, that's what I mean by closing the socioeconomic gap and restoring an investment opportunity, for the middle class, where my dear friend from soccer can now spend whatever they saved up. I don't know what it was. Let's call it 10 grand. She can actually invest her 10 grand into the storage unit on a long-term basis and go. Or if she wants, if something hits the fan or there's a problem, she needs the money, now it's liquid and she can go sell it. And that's what the real game changer is here. So not only do you create the liquidity, but if you take your asset to a secondary market and give the demand that the world has out there access to your investment, then the value of those fractional pieces, the whole thing, but you're selling them in fractional pieces, goes up significantly because your buyer pool is much, much bigger. So it's really a win-win where the people buying the real estate tokens have access to high quality investments that normally accredited investors, or you have to know this special person, you have to know Tyler or whoever to be able to get in on it. Now you can actually get in on these deals. And for the issuer, the owner, they have a digital platform where they can punch a couple buttons and have cap table management and manage those securities much easier, and everything's automated so they don't have that intense investor management. So now you can take on thousands of investors, to where before you better get 10 cell phones and a staff, to try to handle that, and get your attorney an office space inside of your office to try to turn those things. So
at a distance, I think I just want to point out the obvious, that there's been typically a division, as long as I've been at this, which is a long, long time, between those people who get and dive into and understand real estate, and that's it. And then a much more, not that this is wrong, but it's the only word I can underscore, is a much more passive investor that goes into a publicly traded stock world. And they kind of watch their investments, but they're buying into a company, and they're hoping that company does well, makes good decisions, has good management, et cetera, et cetera. It almost seems like a hybrid of the best of two worlds, where the hands-off passive part is certainly a part of somebody buying into a fractionalized ownership through tokens. But they're buying an asset that they can drive by.
That's right.
Look at, study the location, look at the operation, use a lot of common sense, look at an income and expense, look at, is this positioned in the marketplace to continue to do well, like your storage complex, like, oh, I get why this thing is full. It's really nice, it's well located, there's lots of beautiful homes around it. I get why this works. And so I can buy an asset, but with the let's just call it the ease of the stock market. But I would think with a lot more assurance of stability and growth, because over time, real estate is known to be the most stable, the most consistently growing asset that we have. I think it's, and yet it's never been able to be done because of the management and the fractionalized nature. You can just cut this up into as small of pieces as you want to in any asset. Right? And the buy-in of that piece, just if you want to break it up into 500 pieces, great, here's the buy-in. If you want to break it up into 5,000 pieces, the buy-in's even less. Right? But really the management hasn't changed. It's all digital.
Yeah. So exactly. It's not that this didn't exist before. It just wasn't usable. There was no real way to do it without breaking your neck. I mean, people would sell their private equity positions, which is what we're talking about. But you would need to do it in large volume amounts to make the time and effort worth it. And you've got it exactly right, Greg, when you say they can actually walk by, touch it, look at the financials, say, I own, a piece of this, which is very different than like a REIT, for example. A REIT is much more like investing in a company that happens to buy real estate. Where the sponsors of those REIT, or the people that put them together, they have all sorts of different rules and restrictions in what they're doing. And when you buy into that REIT, those companies' shares, and a lot of them are publicly traded, you're just buying into a piece of the profit, which can be okay, but you're certainly not getting a K1. You're not going to drive by the property and touch that and really own a real piece of real estate like you are with the tokenization.
I completely get that. And, well, this innovation, see, it doesn't surprise me at all, Tyler, just who you are, that the road to the cutting edge, the front lines has always been where you will be found. It always has been. As long as I've known you, you're right there. I also think it's worthy of noting that the way we look at real estate today versus you kind of were back in that 2005-06 area when you started right in there. I mean, if you look at everybody go, oh, this is so novel. I don't know what I think about this. Well, I remember when Airbnb showed their face and everybody like, what? You know, you can rent out your basement separately for a nightly rental, and or think of it when all of the various changes in the real estate world that all kind of have to do with the idea of fractionalization, right? Airbnb, split it out, different platforms allowing everybody in the world to rent this, to put a yurt up in their backyard and rent it out by the night, literally, right? And then you look at the transitions between that and say something like pad split, taking a split level house, taking out all the common areas with portable walls, take out all the living room, the dining room, the garage, and turn it into bedrooms rented by the night.
Yeah.
A regular long-term rental that we have always known forever is X.
Yeah.
Put it in the Airbnb platform and it's 1.8X. Put it into a pad split model and it's 3X. The same exact piece of real estate, producing more and making for new availabilities out there in a market that needs them.
Yeah.
Well, essentially, from a digital platform standpoint, it's making available what couldn't have been available before.
Right.
To be in the real estate game, some cashier that works their butt off, but they've got $1,000 and they want to be in real estate.
Yeah.
Where else do you go?
Yeah. And it leads you right to the education. You may start with investing in a couple of these projects, being able to keep an eye on them, see how they're doing everything, get all the info, and then you decide to go do it yourself too. I mean, that's certainly a fast track to it. And if your listeners want, we did put together a guide to tokenization and the top 10 benefits. If they want to just email info@retokens.com, we'll email you an interactive guide on real estate tokenization and the top 10 benefits, so they can have that.
Fantastic. And on a bigger published notion, as long as we're talking about things published that are really worth it, talk to me about your book.
Yeah. So I've got 2 books. The previous book that I wrote, which has a lot to do with seller finance and acquisition, is Freedom Through Cash Flow, how to minimize tax and maximize profits with real estate. But we very recently, I was part of a very cool book project, just launched a couple months ago. In fact, it's an Amazon #1 bestseller, I think in, I want to say 37 categories at least. They did really well. Kyle Wilson, who is Jim Rohn's 18-year business partner, put this project together. It's called The Transformational Journey. And Brian Tracy did the foreword on it. Dennis Waitley's in it. Chris Gronkowski, Gronk's brother, he's in it. I was just hanging out with him in Dallas at a mastermind I was at. A lot of the authors from that book. So they put that together, and there's a lot of entrepreneurial stories in there. And I'll just speak to my chapter real quick, since it's the one I know the best. It really is my transformational journey from where I started, and we talked a little bit about that, to some devastation that happened in between. I had a couple of massive setbacks in my journey that took me to zero, or probably negative, quite really, and how I rebuilt it from there, what I did. And it even talks a little bit about the strategy of early morning coffee cups with kids in the back and driving my area and locating these assets and writing bird letters to them, and how I did that process. And it just really speaks a lot to the mindset that it takes to really take this transformational journey, because we all have massive setbacks. If you're going to have a high level of success, you are going to have some massive setbacks along the way, and it's how you react to them. It's whether you grow from them, learn from them, and take what you learned and apply it. And that's really what that book is about, is the transformational journey of a lot of these folks that have entrepreneurs that have had to reinvent themselves a lot of times to bring it to the level that they're at now. So, in fact, I'll give away a free digital copy of that book to your listeners too. Info at REtokens.com, and the subject will be book for that. On the tokenization guide, the subject is guide, and we'll send you that, but I'll send you a free digital copy of this book. That's awesome. For at info at REtokens.com, subject line book.
That's awesome. You know, this started out with this declaration that somehow, some way, I get the opportunity to know the likes of you and so many amazing people. You just said something that is a common thread. You stated it. I want to underscore it again. That high achievement and a growth mindset is a mindset that has to be ready to handle adversity. Because high achievement doesn't happen without adversity and what you learn through it. The greatest learning opportunity that you and I will ever get is when we go through it.
Yep.
And it's, what do you do there? That's the crossroads. What do you do? Do you stay down? Do you get up?
Yeah.
Do you look for, what is it I need to learn here? And it's not that anybody wishes for these setbacks. Who would do that? That'd be crazy.
Right.
But the fact of the matter is that when you're pressing the equation, which is what growth is, there will be setbacks. And therefore, they've got to become your advocate.
Yep.
You've got to play judo with them, to take the energy of the adversity and use it to propel you forward. And that's a critical ingredient, Tyler. It absolutely is. I think back on our journey, and I specifically, both Ryan and you reminded me that it was in 2010 in Orlando that your graduating class from Power Players turned out to be, you got 50 people coming to every Power Players event, and they're all individually screened to be there. Mm-hmm. But out of that group, you reminded me, the wisdom of Mike Nuss, the tenacity of Chris Botero, the big personality and competence of Jimmy Chandless. What I mean? It's like, wow, it seems like 5 minutes ago.
Yeah.
And it was 14 years ago
that
we just had that. We just wrapped up our 37th Power Players this last week, awesome. Which is just crazy. But when you go back to Power Players, and you go back and you're a young kid there, and so much of this water that we've now talked about wasn't even in sight, much less under the bridge. Right? Give me a couple paradigm shifts. Give me a couple thoughts or tools that, or at least, I'm not asking for a lecture, but I know there were a couple things that came out of that you have utilized and built on greatly in your real estate career.
There's one that's just head and shoulders above the rest. It's quite literally made me millions of dollars. It was the foundation of most of my multifamily acquisitions, and it's really the art of creative finance and the note that I learned at Power Players. I remember, in fact, I still have the document. Until I had memorized it, which you made us do, I believe, as well. But I have that very document, that one page where we wrote out first right of refusals. I've made well over $100,000 just by having that clause on small deals. I've got it built into the bigger deals, so we'll see what happens. But that's the quickest way to make between 20 and 200 grand is when you draw up a seller note. You just put a first right of refusal in there, and if you have a long time period, the chance that the seller will want to cash out at some point is pretty strong. And I've used that. That alone has made me a ton of money. Substitution of collateral and what you call the slice and dice clause. I have used those in practice many times and been able to take seller notes. And when I paid off the buildings, I mean, I bought 22 units, 3 multifamily buildings, textbook, power player, creative deal finance, and the price had tripled, over the time that I owned them. And so the 22 units were made out of 2 8 units and a 6 unit. And I had bought, and they were really low rents, and I negotiated a good deal. So I bought them for like $800,000. So that tells you it's pretty cheap. Well, I sold only one of the 8 units that I wanted to own the least for $860,000 in 2022. So I sold 1 8 unit for more, and I had owner financing the whole time. But the beauty is not that, actually.
Recollateralize the debt.
That's right. That's right. I had 27.5-year amortized no balloon debt at 4%. Is what I negotiated.
Not
on
when
that
you'd
deal.
want to pay off.
That's right. So using the substitution of collateral, I was able to take it from a first position, and I had the proper equity and proper cash flow to put it on other properties. So now that seller became a private investor at 4% amortized,
for the remainder
of the time. And so that $860,000 went right into my pocket, every penny of it. Well, besides the taxes, right? But that's a whole nother podcast. Anyway, but there's an example. So those that I just described that I've used in practice has literally made me millions of dollars. And it not only that is I became known in my area as a creative deal expert, as a seller finance expert, because I'm a student of the game. I'm a student of the things you were teaching. And when you taught that, you talk about a paradigm shift and a lesson, the whole world opened up to me on what could be done. No longer did I view that as an issue. And even some of my acquisition criteria today, I say if there's no seller note, I'm not interested, right? And it depends on that. So that it just head and shoulders above. And there's some sub layers to that. It's not just seller financing. It's all the ingredients that you had baked into that. And then the philosophy on how to approach that. So that by far was the biggest thing. And then an exercise, I don't know if you still do negotiate the ridiculous, but I remember getting a few shirts off some sweaty guys at Disney World. So the combination of being
and you didn't get arrested.
I didn't get arrested. It was quite amazing, no doubt about it.
Every time that group comes back and nobody's in the hospital or arrested, I feel pretty good.
You're in good shape. That's right. That's right.
Right.
But that was also a whole different level to quite literally approach a stranger and ask for the shirt off their back while they're at Disney World. I mean, that was a feat. I mean, you got to come up with. I was like, imagine this. What are you doing tonight? Oh, we're having dinner with the in-laws. There's no way I'm giving my shirt. I was like, is that normally a good time with the in-laws? Well, yeah, it's all right. I was like, imagine this. What if you had a story to take your new in-laws tonight, and you said, you want to hear something crazy? I was at Disney World. This guy talked to me. I literally gave him the shirt off my back. You can go to dinner with that story tonight.
Right.
It was done. Got the shirt. And I was like, so there would be a second thing. So those were really life-changing skills that when you go in combination are huge. It gave me the courage to do things like put together notes with 0% interest and understand that people might say yes and have said yes.
Right.
You know, and I don't just mean on a house deal, which I've done. I did it on a large commercial restaurant building that my dad owns, negotiated a 0% note. So now you're talking
in that building.
hundreds of thousands of dollars in savings and interest from what they wanted. So those are two major life changers that are part of my foundation and what I do with acquisition today.
You know what's interesting about that, Tyler, and it's not like blowing a horn, I don't think, to power players, but it did take a long time to write the outline that has been power players and the staple diet of power players for a long time is that knowing just the toolbox is so important. It's fascinating and it's incredible, but in and of itself does nothing.
Yeah.
Having a mindset of possibility and how we think and how we view the world and what we do and what we don't do, and really understanding the philosophy of our life is amazing. And yet without a toolbox, it does nothing.
Right.
But when you marry correct thinking in both of these areas and you bring it together and you merge it, it's kind of like two glues that in and of themselves nothing sticks, but they're types glues where you squirt a little bit of this, a little bit of this, and mix it up. Be careful what you touch it to, because it's there to stay. Yeah, you're not going to take it apart. It's a chemistry of the merging of the left and right brain, of the literal and the philosophical. And when it comes together, now you see everything in a different way. And you have the tools to know what way to move things. And so I've watched that in it's very satisfying to have the opportunity with the ingredients that say, let's go, I want to learn. And then, like every parent, we just hope to eat the dust of our kids. Well, I get to eat your dust. Today I get to eat your dust.
That's a humbling statement.
It's awesome. I truly love the entrepreneurship, and I love the heart that you have towards teaching people and reading your books and studying your material. And this is what a leader does. It says, hey, I'm going to work hard to figure this out, and I want to help you learn it. And gosh, names that you and I could just go back and forth with. They've become the leaders of their cities. I tell people all the time, pick any city.
Yeah.
Any city. And they go, oh, come on. No. Any major city. And they'll pick a city and I'll say, oh, wow. Well, in that city, this is the dinner you need to set up. Because they're the leader of that city. They're the leader of that community. They not only know this, they're teaching it. They're living it. And I think that heart, too, of wanting to give as much as you want to receive is obviously that's the gate. That's the open indoor gate to power players. Yeah. No tight pants, no arrogant, no assholes in power players. I screen them all out.
Yeah.
The one who wants to give as much as they want to receive, that's the heart that I want to invest in. And so it's just exciting to see you do your thing, my friend. And you've got an incredible family, a beautiful bride, beautiful kids. I'm trying a hard time picturing you on the soccer field. If that is loving hugs or like military, I'm not sure, but I know how competitive you are. So the girls' soccer team.
Well, we didn't play her team. Otherwise, it could have been, and it would have depended if we won or lost, probably too. You know. But.
I just think it's awesome. And brother, every one of these, as you know, it starts with the starting word, but the challenge here, the consider challenge, is what we've been talking about. And anybody who says, I want to know this and do this better than anyone, well, that statement says, I'm signing up for the front lines. You don't get to claim that by sitting in the stands watching.
Right.
You just don't.
Yeah.
You get in the pilot seat of that plane, and it may feel over your skis, but you've got enough to know that this is where you want to be. But that that choice to feel uncomfortable.
Mm-hmm.
This is what I want people to consider. It's like, what do you want to be so good at, so known for? And be careful what you say, because in saying it, by definition, you're saying, I'm going to be cutting edge.
Yeah.
I'm going to be an innovator here. I'm not going to wait for all the shooting to stop before I walk in the door.
Mm-hmm.
I'm going to be the first guy in the door.
Yeah.
And it's a bit dangerous.
Right.
I feel like I get that.
Yeah.
Half of these clauses that I'm making you memorize, I remember saying, well, I wonder if this is going to fly, you know?
Yeah.
But you try it, and pretty soon it's maker of notice, first right of refusal to purchase note, you beneficiary elect to sell note prior to maturity. And you it's your bloodstream. You know it. You've lived it. You know, this is being an innovator right there at the sound of the guns. Not 20 miles back in camp wondering how it's going on the front lines.
Yeah.
So you live a front lines life, and that's why you're worthy of studying. That's worthy of mentoring, worthy of learning from, because you're not just the stance, the coulda, shoulda, wouldas, the I see it this way but never really get close to the action. I just love that you're right on the front lines, and what's ahead is you got a front row seat because you're right there. So, man, you've given a website. How best do you want people to communicate with you? And I asked it because we all have our best medium. I want people to be able to throw questions your way to say, how do I do this? Where do I learn this? You know, what's the very best way to get a hold of you directly?
Yeah, I would say LinkedIn. So just Tyler Vinson on LinkedIn. I'm the CEO of REtokens. I'm the CEO of Exton Investment Company. And that way you can DM me too. If you're listening to this podcast, I'll open the door to where you can DM directly to me. Mm-hmm. And I post educational information on there and some different things we're doing. So
awesome. Come
find me on LinkedIn.
Perfect. LinkedIn. Yeah. Well, brother, this podcast and this challenge is just awesome. And again, this is not on your way to anywhere. And so I appreciate you and your bride, the whole family, being here, heading back. It's a 3-day effort, and I get it. But I truly know the value you're bringing to people by being here. And just the pride I feel that you're sitting here, that this is everybody's dream, is that your investment of heart and all those times to push you. Wow, one-on-one, those coaching times, really dive into it. It's just so awesome to see you now leading point. And so thank you for being here. And to those of you listening, this is one, especially if you really, really, really hardcore into the weeds, because we got just enough into the weeds. Rewind it. Listen to it 20 times. Take notes on it. There's so much there. That was pure espresso. And to direct questions to Tyler. And for all of you that are listening in today, thank you so much. I look forward to our next time together. From both of us, God bless you.
Thank you.
Thanks, buddy.